Hello, everyone. Thank you for joining on a Friday afternoon. We welcome you to our monthly webinar series. Let me just introduce you to our speaker, Mr. Aman Chauhan. Uh, he is the senior fund manager at Abacus with over years of experience in the investment industry. And before joining Abacus, he has managed both local and offshore portfolios at Reliance Asset Management, including a stint at their Singapore office as well. This exposure has given him a strong regional and global perspective in his investment approach. And academically, Aman holds an MBA in finance from KJ Somaiya Management and a bachelor's degree in Mithai College. So, with this depth, expertise, and proven performance across diverse strategies, we are excited to hear from you, sir. Over to you, Aman, sir.
Yeah, hi, good evening, everyone. Thanks, Aishwarya, for starting the call. I believe my screen is visible to everyone, and the agenda, as stated, is give you a broad perspective as to what the market outlook is, especially in the backdrop of the events that has unfolded over the last few days, right from US tariff to uh, you can say a bounce back in the market, and then again last few days where IT stocks and some other stocks have also taken a fallback in the wake of global uncertainty to currency which hit 92, coming down back to 90 half levels, and uh, anything and everything else related to markets. So uh, it's been, I'd not say uh, challenging, but you can say very exciting times over the last 12 months or so. And let's start with a quick recap as to how the markets were in the last year, say year ending December, Jan. We are in Feb right now. And as we see on your chart at the bottom right, CY25 was a year of one mean reversion, and
So the screen is not reflecting.
uh, one thing, I think there's some technical error and the screen is not visible. We'll just sort it out. One second. Yeah, hi. Sorry, we are back. I believe there was some technical error with regards to the presentation. I believe now it's visible to all. Hmm. So I was mentioning that the year gone by, calendar year of 25 up to December Jan was a year of consolidation and also something which we call as mean reversion, a year when large caps did well, mid and small caps significantly underperformed, especially the small cap. But as you see on the chart at the right bottom here, this is something that mid and small cap underperformance come after a stupendous 2 years of return, where then the return was 2x of what the large cap return was, right? And hence it was normal to expect some kind of consolidation, some kind of mean revision, some kind of bounce back for large caps to come back, and that has happened. So that is one big trend that we saw. The large cap return also was almost like a 9-10%, which on an absolute basis is not a bad number, a double digit kind of a return from markets. And I believe your active funds would have generated some alpha over this. So in that sense, yes, it's not a bad number per se, especially coming on the back of strong years post COVID. The consolidation happened, as we all know, because there was delay in the US tariff conclusion, and at that point of time, we had a 50% tariff duty, which was too high. Valuations are also on the higher side, post the strong rally that market had seen. We saw record FI outflows coming in, plus lots of money getting diverted to the IPO markets. Globally, the trade was AI, data centers, chips, semicons, and anything and everything related to AI and computing, where Indian companies don't have a strong presence, or in that sense, a meaningful presence. So not much of money moved into Indian markets, as there was no AI trade in India per se. Year before that, there was slowdown. Things were started to look up, so not many people were excited, and a combination of all these factors put together is what the market saw. So it's like a relay, right? If you're running a race and there are 5 laps, you cannot be first in all the 5 laps, right? After 1 or 2 laps, you need to take a breather, you need to cool down, you can, as a way to recharge, right? You need to take a breather, and I believe that's what happened for India. And it's good in that sense. You cannot have linear returns, you cannot have non-stop returns. So overall, this kind of breather for CY25 was something which is a welcome change, and it happened due to rightful reasons. If you ask me why did it happen in 25, why not in 24, why not in 26? The reason is already, as I mentioned to you, US tariff delay was one of the biggest reasons, along with slowdown. So, but at the same time, whatever happened at the ground level, the government was very proactive. The moment they saw slowdown happening, which was last year, second quarter of last year, the GDP was 5.5, which was like a 7 quarter low, right? So that was the real slowdown in India, because the bottom of the pyramid demand in India got impacted due to high inflation. The government was proactive, so it started with tax cuts last year budget, followed by rate cuts by RBI, various OMO measures to infuse liquidity into the system. September we saw the GST rate cut coming in, and and accumulation of all this is what the government has done so far to revive the demand. And the good thing is demand is already revived, right? So this is just a flashback as to how the year went by, what all challenges we faced, and what was the government response to that? As things stand today, things are materially different. Also, one thing I would like to mention, that we all say that last year has not been so good, market has not been so good. We all say it in a perspective that mid and small caps have not done well. But if you see, overall markets have done well. Also, one thing that has been a significant change is India's performance versus global markets. So if you see the chart here, this is what India's performance is, the chart in yellow, which is a 10% return, which on absolute basis is not bad. But on a relative basis, you see most of the other markets are higher than us, whether it's a US market, Taiwan, Korea, Hong Kong, Singapore, even company, even a German market was much higher than almost 2x return, or a UK market where things are not so great. Still, they had a good bounce back. So on a relative basis, India's performance in CY25 was one of the worst performance in the past 2 decades. Typically, India is always in the top quartile. If the world markets have done well, if the world economies have done well, India would be in the top quartile. Wherein FY25, India was not just in the top quartile, it was in the bottom quartile kind of thing. So this was the worst relative performance. Though on an absolute basis, we still had a decent 10% return. This is obviously in the local currency. If you take the INR depreciation for a global investor, this would be a 5% return. And hence, on a dollar basis, the relative return was even bad versus an absolute basis. And that's what a change in, you can see the markets were for CY25. So we as local investors don't feel the pain. For the global investors, this was one of the worst performing markets last year. And that has put in lots of questions as to what the sustainability of the growth in India is and what the market outlook is. And I'll try to address that today. So as things stand today, what is the situation? The situation that we all know, the US trade deal has happened. The significance of that is that not just the trade deal is concluded and hence the uncertainties behind us. The significance is that we are today at an 18% duty, which is slightly higher than what it is with EU and marginally lower than most of the competing peer nations, which is Thailand, Malaysia, Bangladesh, Vietnam, they're all around 19-20%. China is around 35 and so forth, right? So on a relative basis, we are better off versus the competitors, versus the peer group, and that is what the big change is. Because during the whole of last year, we started the year saying that Indian India and US get along well, tariff on India is going to be much lower. But as and when we got a 50% tariff due to buying Russian oil, this is what the US claimed and put a 50% tariff on India. That is the time when the fear was maximum that the relationship between US and India is not so great. In fact, it has turned bad, and the final outcome could be much worse, and the tariff on India could be higher than its peers, and that would be a big competitive negative for India. But that fear is now behind us. 18% is what the number is, and that's something which is very good. And as you see on your screen on the left bottom, this is the trade surplus India has with US, which has been constantly rising and almost doubled in the last 5 years, which means that we have been gradually exporting much more to US and also reduce the imports from US, and hence we have a very favorable, you can say, trade relationship with US, and now this tariff will even make it better, right? This is what was at risk. If it was a negative impacting tariff, a tariff higher than the peer group, then this trade surplus could have come off. But now that's not the case. You see the scenario here on the monthly, the top right hand side. This is what the monthly export was, which got impacted due to the tariff. It stabilized. Expect this to again start moving up. So this is what the relevance of the US trade deal is. And as we all know, US is world's largest economy. It is the biggest demand economy. It is where you earn one of the best margins. And anything negative on that side would not been very good for not just the exporting country or the company, but overall from a sentiment perspective for the whole economy. And that fear is now behind us. Having said that, we all know Trump is Trump. We have announced 18%. Tomorrow morning itself, we can come and tell that no, there is some change, something has happened, something has not happened. 18 goes to 28, it goes to 38, 48. I don't know. It can happen. But having said that, there has been a joint press release. Chances of that is unlikely, but I cannot say that it cannot happen because this is Trump. Here, he is not stupid, but he's crazy. We all know that. And it's not just a 1 month trend. This is something that we have seen for months and months together, right? So need to be not careful, but yeah, aware of that fact that this is Trump. So take it with a pinch of salt kind of a scenario. The other big thing that has happened is the EU trade, which is also significant because of the fact that India never had a trade deal with EU nations. After US, they are the biggest, you can say, economic region. And more so important because our neighbors and competing nations had a trade deal with EU. So they had MFF status, which is the most favored nation status or a preferred nation status, and hence the tariff that a Bangladesh or a Sri Lanka or a Vietnam would pay in EU was significantly lower than what Indian companies or Indian as a country used to pay. And that is where uh, the significance of the deal is. If you see, our trade relationship with EU is almost similar, slightly more, but almost similar to what we are with US, right? So it is as big as US for us, and hence this trade deal is something which is significant. It is very favorable. Almost 96% of goods which is exported to India will see lower tariff, which means cheaper imports for us, good for us. Inflation will be low. We'll be able to import at a much lower price. Plus, 99% of the exports that we do will also get a reciprocally lower tariff, which makes us much more competitive versus our peer groups now, right? And that is something which is significant. Anyway, we want to reduce our imports, so this deal net is much more favorable for India than it is for EU, and that's the way it is. And probably this is got signed because EU also needs access to the exports than India does, because obviously which we are much more price competitive uh, to the EU than other nations. And everybody, as we know, wants to reduce the dependence on China, right? So this is something which is also some significant that has recently got concluded. We saw the budget. We all know the numbers. Not much to repeat on that. Only 2 points. One, in spite of the challenges, and the challenges was that government had a tax cut and a GST cut last year. So obviously revenues were lower. There is no free lunch, right? So as consumers, we benefited from cheaper products, lower tax outgo. Somebody had to pay for it, which is the government of India, where the tax revenue is lower. In spite of that, they have stuck on to the fiscal responsibility. That was the key highlight for the budget. Second, there was fear that since the income of the government has gone down, government will spend less, which is obvious. Less income, less spending, since you want to maintain the fiscal, and hence the spending that the government does, the capex or the infra creation that the government does will get impacted. But that has not been the case. You see the numbers on your right hand side on the screen. This is where the key industries where the government capex happens, and there's a good high double digit kind of growth in the budget estimates for the current year, and that also bodes well both for the growth recovery as well as sustaining the momentum in India, right? So there's one which is private capex, which the private corporates do, but the government capex is also equally important, and that's where that's been a right balance in the budget. And this is to us also not a firework kind of a budget, but a decent budget in the circumstance in which the government was. And there was no tinkering as far as capital markets is concerned. So that is also something which was a positive sign per se, except for that small FNO thing that came in. Coming to the INR, there has been a topic of discussion since a few months now, especially in the last 4 5 months, because that's where the sharpest INR depreciation has happened. If you see in the last 1 year, INR has lost almost 6%, right? So similar to equity markets, in the last few years, in the last decade or so, INR was also among the relatively better currency. Like equity markets, we are also in the top quartile. Last year, that has changed. So not just the markets did not do well, even the INR took a beating and it was down. So we all know from 85, first went to 88, then went breached 90, went all the way up to 92 odd levels. But if you see the forex reserves, during this whole period, the forex reserves have stayed strong. Nothing much changed. Modi was still the governor. We had rate cuts. Economy was picking up. Growth rate was picking up. Hence, there was no real reason to INR for depreciate on its own. If it depreciated because of dollar appreciation, then all currencies would have depreciated. But here was a case where specifically INR depreciated, and to us looks like the RBI allowed the INR to depreciate. It realized that there's going to be a tariff on India. The tariff number could be higher than what they initially thought, and they need to compensate the exporters. And hence, I believe the government consciously allowed the rupee to depreciate, right? And as we speak now, once the trade deal is concluded, the number is not high as feared. Uh, Rupee has seen some pullback. Expect the rupee to stabilize here for the next 1 to 2 years at the current level, unless the dollar moves. But on its own, expect the rupee to stabilize, and that has been the rupee movement over past several years now. That there is a step up fashion in rupee. 1 2 years it is stable, then suddenly 1 year there's a 2 to 3 rupee move. Again stabilize it, again 2 to 3 rupee move, and that is what has happened. This time around, it is slightly higher, but I believe bulk of the move is behind us. If anybody has a view that rupee can appreciate from these levels, it can marginally in the near term, which is be more of a pullback of the sharp depreciation that we are seeing. But overall, we and that's what been the trend for multi decades now. INR is a depreciating currency, right? Predominantly because the inflation differential and the interest rate differential of INR versus USD is different, and that gap needs to be adjusted, and the currency is the factor that adjusts that gap, right? So everything else gets expensive, then the rupee also needs to get expensive. That's the high cost of inflation one pays, right? So we feel this trend will continue, that the INR will be a depreciating currency, but in the near term, it can see a pullback, and the depreciation is not going to be the way it used to be 4 5% earlier. It's more going to be 1 2% annually, that too in a step up fashion. So maybe at least in the near term, we will feel bulk of the depreciation is behind us. So this is broadly where the current situation is, what has changed in the last, you can say, few months, and based on that, what is the market outlook that we have. We feel the Indian market is poised for a decent return in the current year. We are in the start of Feb right now. If you have to take a 12-month view or 24-month view, it's always better to take a 24-month view than a 12-month view. But on a 12-month basis also, we feel things should start to look better for a simple reason that GDP growth has started to move up. It is already higher than what it was. So 5.5 was the 7 quarter low that we saw in second quarter. We are already at 8.4 in the third quarter. Expect this to sustain here, maybe half a pips here and there, and then again start to move up at 8-9% GDP growth. We are in good hands, right? So this is where we were close to 9 odd levels, gone down, recovery, and hence it's not a hope trade. It's not a trade that you will say that, oh, the GDP has to move, economy has to do better, government has to do something, things should get better, sentiment is weak. No, at the ground level, things have already recovered. It's not a hope trade. Since it is numbers already recovered, we feel earnings growth will also catch up. This is what the broad trend is, the chart on your right hand side. You see the GDP growth, if it spikes up, the earning growth spikes up, it goes down, earnings gets impacted. And now we see this trend going up. So GDP growth should accelerate, and so should be the corporate earnings growth. And ultimately, that is what gets reflected in the equity market. So this is one big trend that we see, and that's the reason we are pretty hopeful. The uncertainty that we had on the global front is also now behind us, and hence that's where the view for the market is. Besides earnings growth, the other important factor is valuations. You see, currently we are closer or slightly lower than the 10-year average on Nifty basis. On a price to book also, we are almost at 10-year average, and this is where, during the COVID time, the market tends to bounce back. It takes support during near the 10-year average where we are currently, and then it starts to pull back, and this is where we are poised right now. So from a valuation perspective, also since the last 12, 15 months, market have been, or stocks have been flattish, mid and small caps are down 20, 30% from the high. And then at the same time, there has been earnings growth. So the market valuation is adjusted to that extent. And it's a fairly priced market. I not say we are a cheap market. No, we are not yet a cheap market. India mostly doesn't trade cheap. The call in India always is whether you're buying more expensive or less expensive. And there are hundreds of reasons why India should trade at expensive, not just the demographics or the under penetration, but the other factor that we have, which is basically the longevity of growth and the cycle that we are in, where from a developing nation, we are headed towards a developed nation. So there are enough reasons to justify India's premium, which has been there for decades now. So the call is more expensive, less expensive. Right now, we are less expensive that way. It's not a cheap market. A fairly priced market is what I can say. And hence, from a fairly priced market, the return expectation will also be fair. If it is cheap market, you can expect a higher return. From a fair price market, fair return, which is, I can say, mid-teen kind of returns is what something Indian markets can offer in the near term, as well as over a medium term is what the outlook that we have. And that's what we feel on the valuation front. Also, it's not just the absolute valuation, on a relative basis also. Since I said that last year, on a relative basis, India has significantly underperformed. On a relative basis also, today we are much better off. This is the India's premium versus the peer group. So this is Nifty's P premium over MSCI emerging markets. So this is accumulation of all emerging markets. This is what the 10-year average is. We are now on a relative basis below the 10-year average. We are significantly below the last 5-year average when the markets have been good, right? So good amount of valuation comfort has started to come in. And this is the period where, except for this COVID year, this is where the markets tends to stabilize, right? That's 40, 50%. We are already around the below 50% premium kind of a thing, right? So not much of downside left on a relative basis also, and there's a good chance that this premium comes back to the 10-year average. So not just absolute valuations, which is there, on a relative valuation basis also, we are now much better than we are. Obviously, the question in mind would be the what is the trigger? 1 month back also, 2 months back also, we have relatively better. Yes, at that time there was no trigger. Now the trigger already come in the form of US trade, EU trade, and hence I feel that now the time has come when things start to move up. Coming to the other point as to when the FI selling will stop, what is the liquidity scenario? Because this is one of the biggest, you can say, sentiment impactor for equity markets as to what the liquidity situation is. Uh, I feel once Indian market starts to perform, which has not been a great performance for several quarters now, the FI money will come back. And the good thing is that domestic liquidity continues to remain strong. If you see the chart here, this is what the FI ownership is, which used to be as high as 22%, which has now fallen below 18%. And domestic, which was somewhere here below 20, has now almost reached 28%. So you see that this big gap here. So the domestic institution now has a larger say, which is good for the markets. Because if FI ownership used to be pretty high, then India was much more dependent on global flows, on global sentiments earlier than what it is today, because domestic institutions have taken the front seat now. And this is what the cumulative number is. If you see that this is the trailing inflow number, and this is what the domestic flows has been. So while FI's flows drop, domestic flows have seen a record inflow, and this has completely negated the outflow. Had this not been the markets would have lost another 10-15%, but that's not the case. And this is something which is good. And bulk of this money is coming via SIP, which is very stable money. Uh, there's been a sea change in the kind of savings Indians do, the young generation, the young population that is getting more productive, which is getting the workforce. They are investing into financial assets versus physical assets earlier, and that's brought in this change. I think this is something which is sustainable. Once this reverses, then we get into a scenario where this, which is the FI flow, is also high, domestic liquidity also, and that is going to be the perfect time for the markets to rally. Also, one thing that needs to be very clearly highlighted is that the numbers that we track regularly is basically the secondary market sale of FIs, that they sold 5 billion, 10 billion, 20, 30 billion. Yes, that number is right, but that is only one corner of the story. There's also amount that comes in into the IPO market, into the primary market. In CY24, that amount was almost same as to what the FI selling was. So while we say that it was a $15 outflow, eh, the net outflow was flattish because we had a similar amount of IPO money coming in. Last year also, when we seen outflow, we have seen inflow coming into the IPO market. But yeah, net, we have seen good amount of outflows, almost 18, $19 billion of money that has gone out, and which has got negated by the domestic flows. January also, we have seen net inflows. Feb has been better post the budget and the recent conclusion, and hence we see this trend also reversing that way. So then on the liquidity front, other things should get better. And just to highlight, it's not just India. Many countries in CY25, most of the peer group except for Brazil, most of the peer group also had an FI outflow in CY25, right? So it's not that it was only India that got signaled out, and hence not unduly worried as far as the FIs are concerned. I think once growth starts to pick up, which is already happening, and market starts to perform, they will also come back. Macro dynamics is pretty strong. 10-year yields are stable, headed down. Repo rate is down. Feel another 25 bips of rate cut is there. Most important, crude is around $60 to $63, not going up. There could be a momentary spike here, but I don't see structurally crude moving up much higher. So in that way, also from economic perspective, we are much higher. Inflation is low. In fact, too low to comfort. I feel inflation will start to inch up. That happens, which is good because low single digit inflation is good for the economy. That shows that demand is more than supply. And that is what an ideal situation is. And also helps in the nominal GDP growth of the country. So expect this trend also to start moving up. So this is where the markets are. And uh, the other high frequency numbers, as I said, are all trending up. That is what is already reflected in the GDP numbers. And finally, it comes to earnings outlook. So as I explained, earnings outlooks broadly track the nominal GDP growth. So the real GDP is picking up, inflation is picking up, nominal GDP is picking up, and hence earnings growth should also start to pick up. And that is what we have already started to see. For the current year itself, from Jan and Feb onwards, we have seen earnings getting revised upwards for all the measures as well as the budget and the other measures that have already come in, and we have seen this trend coming in. The result season so far, if you have to look, uh, this is what the last quarter number was, or this is slightly typo, this is the 3Q numbers. You see the mid and small cap earnings growth has been 15 to 20%, right? So large cap number is flattish. This number is slightly negative because of the labor code adjustment that has happened today. Adjusting for this, this is like a plus 4 or 5% growth number versus what the reported basis number is. And mid and small cap is already higher. And that also answers the query as to when will mid and small cap start to perform. While some of the mid and small caps are more expensive than large caps today, but it is justified because of the higher growth rate these companies are delivering. And we feel that soon in the next 1 or 2 quarters, once large caps start to perform, mid caps will also join the rally. So it's not going to be a long period where only large caps will perform. We feel the mid and small caps should also start to come in early. So this is where the outlook is for the markets. Having said that, there are also some risks that one should be aware of. And the biggest risk to me is more global than local. Locally, don't see much of risk because things have already started to improve, right? So it's not a hope trade as I've been telling you. Globally, what can be the biggest issue? The biggest issue is one, the Trump factor. Things can get topsy-turvy. He can go, take an U-turn. Things can be very different with him. That is something. What he does, the way it has happened with Venezuela, it can happen with Iran, it can happen with somewhere else also. That is something which is also not good for the thing. Also, one big thing in this tariff war is that tariff war has got extended on the currency front. If you track broadly the way US dollar has been, once Trump got elected, he wanted a stronger dollar because that is the way he can negate the tariff impact on the economy. But the fact is that within the few months when he got elected and the dollar became strong, overall dollar today is lower than what it was when Trump got elected. So when Trump got elected, dollar index, DXY index was 103, which hit a high of 111. And as we speak today, it hit a low of 96. Right now, we're on 97, 97 half level. So dollar has weakened. Maybe the central banks globally have teamed up against the dollar, saying that if you put tariff on us, then we don't need your dollar. And the you can say supremacy of dollar as a currency is getting questioned, it is getting challenged, and that is what I believe Trump is not going to like. He already doesn't like it. He might make some announcements, maybe talk the dollar up or something, and that is also risk because if in a rising dollar environment, what will happen is that for no fault of us, if the dollar has to strengthen, then this 90, 91 rupee can go to 92, 93, along with all other currencies. So, Thai baht to INR or a Sing dollar to INR or other currency to INR might not go up or down. That will be stable. But on a specific INR to USD, we can go to 92, 93 if dollar was to strengthen. I don't expect the INR to depreciate on its own. This is one risk which is there in the markets because in that scenario, global money will not come to India because people will prefer to stay invested in dollar, which is appreciating versus deploying money in a depreciating currency. So that is one risk one needs to be aware of besides the geopolitical situation. And also globally, bearing the AI trade and the investment that we are seeing, we are not living in a high growth environment, right? So there is not much of growth in EU. The Russia-Ukraine crisis continues. China has slowed down. Middle East also is okay because oil prices are not very high at 60, $62. They make decent money, but it's not the 70, 80, $90 kind of euphoric environment of demand in Middle East also. So it's not a very high growth environment around us, right? So, and any slowdown there can also have an impact on the markets. And that's what broadly what the risk is. So it's more global than local, and in a way makes life more difficult for us because we cannot time this, we cannot predict this. Have to be reactive to what happens globally. We can't be preemptive for global events that way, and that's something that one needs to be pretty much aware of. So that's broadly what we feel the outlook is. Uh, Expect decent returns from Indian markets over the next 12 to 24 months, double digit kind of returns. It's not going to be a V-shaped recovery for the markets because for that, globally things have to be aligned, which right now is not the scenario. US markets also facing some fatigue. They're also facing some resistance at the current levels. We are already seeing AI announcements coming in and tech stocks taking 10, 20, 30% beating. In fact, stocks like even Microsoft are down 25% from the highs because of this AI thing. And in India also from the likes of Infosys, TCS to all the other companies, they're all down 20, 30% from the not even 1 year from a last 1 month or 2 month high kind of background, right? So things like this is always the risk in that sense. So, uh, wherein that risk, I think this double-digit kind of return from India is very much possible. If somebody has a view that if US markets were to go down or the AI trade in US, which has done very well, were to mean revert and people will book profits in AI trade, then that money can come to India. Uh, we don't share that view. We feel in the near term, what happens is that if the US market goes down, sentimentally, Indian market also goes down. Right. We might be relative outperformance, but not absolute outperformance. So if US market were to correct 10%, India might correct 5-6%, not 8-9-10%, but 5-6% Indian markets can correct. And that is something which is very much, you can say, possible. So I don't see a scenario where unwinding of the AI trade or the data center trade in US will lead to more inflows. Eventually it can, but not in the near term. So for me, it's more of a risk than possible positive scenario coming out of US. And that is what one needs to be hopeful of. So earnings growth are coming up. Economy is doing well. Uncertainty is now behind us. Liquidity is strong. Sentiment yet is not that strong because of the global issues. Once that change, I think sentiment will also change. As you know, it just takes a day's time or a week's time for sentiments to turn, and markets will start to do well. So very confident in markets, and importantly, expect mid and small cap also to participate once the market moves up. So it's not going to be just a large cap rally the way which we have seen in the last 12-15 months. So expect both large cap as well as mid caps to do well in the near term is what we are. On the portfolio fund, whatever cash we had, half of that we have already deployed over the last week, 10 days. We have bought 5-6 new names in the pharma sector, something on the financial side, something on the capital engineering side, because this is where the exports will resume to US. So these are some of the sectors where we have added on to exposure. We had already trimmed our IT exposure 2-3 months back, not just recently. So that indirectly benefited us. IT would be say low, mid, not low, say mid single digit exposure in our portfolio. So not much of IT exposure, and hence the current fall in IT has not impacted as much. We went overweight metals more than 6-9 months back, though it's volatile, but net that exposure is also being a positive impact on the portfolio, and that's where the sectoral preferences are. We had a tough period for all cap fund, which was the large and mid cap portfolio a year back. Last 6-9 months, we have seen decent recovery coming in, and that underperformance has got reversed. On the emerging portfolio, which is the dedicated mid and small cap portfolio, since the mid and small cap index has not done well, and markets have also not performed, this portfolio also has not performed. But as I mentioned, expect mid and small cap also to start contributing to the market returns in over the next 12 months. And once that happens, pretty confident that we'll be able to come back the way we have already come back on all cap. And as historically, we have been that whenever the market does well, the mid and small cap portfolio does well. So that's where the market outlook is. That's what the sectoral preference are. That's what we have been doing. Uh, I'm sure I'll take a pause here. I'm sure you guys would have some queries, except for stock specific queries. You can put in any of your queries related to global markets, local markets, earnings, portfolios, and you can put it in the chat box, and we'll be happy to address them now.
Yes. Thank you, Aman sir.
Yeah, we can start the Q&A.
Yes, sir. So, sir, so your general view on the current PMS strategies and whether this is a right time for the additional investments.
We think so that this is the right time for additional investments. If you don't want to come in all in, you can stack it over the next 1-2 months. Don't stack it over the next 12 months, because once market starts to move, it's going to be a decent rally upfront itself kind of thing. So we feel yes, it is the right time to top up if somebody is looking to top up or to make fresh entry into the markets. Bond yields are coming off. Um, don't see that moving up. Equity markets have underperformed. You can see things moving there. Gold and silver, the way they have been volatile, I don't see, except for genuine demand, much of investor speculative demand now coming through gold and silver in a big way. So from all that perspective, equity looks like a decent bet over the near to medium term.
The next question is one big reason for the FII outflow seems to be the AI trade that has taken money to US, South Korea, and Taiwan. What's your view on the implications for this in the Indian market?
So as I mentioned, if this AI trade has to unwind, do I see FI flows coming in? Unlikely. Overall, yes, if there's gradual profit booking there, can that money come back to India? Yes, definitely that can. Even if the AI trade doesn't unwound, hence valuation in India is now much better than what it was. We are fairly priced, decent growth is improving. Based on these factors itself, I see FI money coming back. So it's not just AI. Overall, we feel India should start to see FI inflows coming in.
Your views on mid cap, small cap, or better, either we should go for large caps or mid and small.
I think the answer to that is more to do with individual self-assessment as to what their risk-taking ability is, what is their volatility taking ability. It is pure math that a smaller company on a smaller base can grow faster, and if you can grow faster, you get a better multiple and you have a better growth and you have a better return. Hence, over a period of time, we feel that a small and mid cap can do better than a large cap because the growth rate there is factor. Having said that, these stocks are much more volatile than what a large cap would be. So if you're okay, if you have the time frame of 4 to 5 years and are okay with the near-term volatility, then overall mid and small cap will give you a better return, which has been the historic case. If not, you need something which is balanced, then go for a balance of large cap and mid caps. Don't go just by the market with the last year large caps has done well, so now this year mid caps will do well, and then again next year large cap will do well. No, it doesn't happen that way. So it need not be a large cap versus mid cap call for you. Go with whatever you're comfortable with, and based on that, take your investment decision is what my suggestion would be.
Okay. The next question is we see a significant correction in IT stocks from the all-time highs. How long does the trend looks like to continue?
The correction in IT is global led. We have seen stock correcting in Nasdaq, and the impact of that has come onto Indian stocks, and hence difficult to say as to how long this will continue. If US stocks were to correct 10-20% further, Indian stocks will also correct 10-15%. Right? Infosys, TCS today for 5-6% growth on a high base, they're still trading at 20 times. This 20 times, can it become 15 times? It can. Why not? These are great companies, great management, globally competitive, but on a high base, struggling to grow even at double digits, right? And we have seen time and again, if the growth rates get challenged, then the multiples don't sustain, right? So we have already seen the derating for IT sector to happen. The 30 P is already become 20, in some cases even below 20. It can go to 15, it can go to 15, right? So in that sense, I'll not say that the worst is over and this is the time to buy IT. Yes, IT can correct 10-15% further, yes, but at the same time, it's not going to half from here because now we have a decent dividend yield also coming in, and then going to be buyback also because all these companies also have net cash balance sheets. They don't have debt and they generate free cash every year, which will get used for buybacks, for dividends, right? So there's going to be some support here also. So my sense would be start to nibble at IT names. You won't be able to pinpoint the bottom. It can correct further 15%. Yes, it can. It's not going to get 30-40% from these levels. So be prepared to start buying now and keep on buying for every say 2, 3, 4, 5% to move lower and then build up your position. That's broadly what uh, we feel one should look at IT stocks.
The next question is your views on the decline in realty sector.
We are fearful in the real estate sector last year because market was not doing well, and that was one of the big, you can say, demand drivers for real estate, especially the investment-driven real estate demand, because people were making good return on equity market, and some of that money was moving to real estate. And since market didn't give much of return, we felt that the demand would slow down. On the fringe, expensive or luxury market is seeing some slowdown. It's still a positive number, it's not a negative number. Super luxury segment is a very small segment that is seeing very good growth. That growth continues. Affordable housing continues to do well. So from an industry perspective, I'm not worried. Stock perspective, most of the stocks are already halved from their highs, and hence from here on, it makes sense to be positive on them. So from an industry perspective, I'm not unduly worried on the real estate sector. On the fringe, some players, some segments might see some kind of a slowdown. Out of instead of 20% growth, we might have a 15% growth, something like that. But nothing to be too fearful about because the interest rate scenario is also low. Right, the rates are low. Maybe there could be another 25, 50 pips of rate cut, which will also help the real estate sector in that sense. And hence, outlook for the sector is, you can say, neutral to positive.
Uh, your thoughts on the pharma sector and where is it that we see the opportunity in the value chain?
We like pharma a lot, uh, and we have in about the last 12 months increased our exposure in the pharma sector. Within the pharma space, we never had hospitals earlier in our portfolio. Now we have started to look at that segment also. We have invested in some, in a small way, but in the hospital names also. That is one sub segment in the pharma space that we like. We like exporters. We like domestic companies also, but the valuation there is always on the higher side, and hence not much of them get reflected in our portfolio. But the outlook there is good. We are not crazy followers for near-term trends like a GLP-1 opportunity or you can say biosimilar kind of a opportunity or CDMO kind of a opportunity. For us, all should get ultimately reflected in the earnings growth rate and the price that we pay for it, right? So if a CDMO company, just because it is CDMO trades at 40p, not my cup of tea. But a company which is growing at 15, 20%, trading at 15, 20, 25p, whether it is CDMO or a non-CDMO, I'll be looking at that company. So not much of, you can say, segment-wide preference that we have, but overall we feel pharma should do well. Decent companies like IT, decent balance sheets, good management. We are globally competitive, and this is one area where there is price inelasticity in that sense. Tomorrow, if things had to get more expensive, I don't think demand for medicines goes off, right? So from that perspective, pretty positive view on pharma space, but more positive on exporters and global pharma companies than pure play domestic pharma companies.
Okay. The next question is your views on the budget.
I'll say budget was a neutral to decent kind of an event. There was no fireworks. There was no special emphasis on stock markets per se, because since we are from the industry, we talk more of stock markets. From an economic perspective, I think it was a very decent budget, not fireworks, but decent because the fear which was there because income is lower and hence government spending will be lower. That has not come through. And in spite of maintaining a growth in the capex and in the infra spend, and the fiscal math is also managed well in that sense. So overall, we feel that it's been a decent balancing act on the budget front. We always crave for more. We always feel that there should have been something more to come in. Yes, that's always the case. But whatever has come in, at least there were no negative surprise, and it was a decent one.
Okay, so we have almost covered the questions. Last one, top five sectors that can stay positive for next 12 months.
Financial is one, pharma is one. We are pretty positive on metals also. Cap goods engineering companies should do well. Domestic manufacturing companies, EPC companies, which have been on the receiving end because the government tendering activity was pretty low over the last 12, 15, 18 months. That also should start to come back. That is one segment which should again start to do well. So domestic manufacturing sector, pharma, banking, cap goods, where exports will resume post the tariff clarity coming in, would be the preferred sectors for us.
Okay, sir. So with this, sir, we can conclude the call. Any concluding remarks?
Great, thanks. Thanks everyone for joining us for this market update. As I mentioned, now we have global clarity. Domestic demand is picking up. Markets have done nothing great on an absolute basis. On a relative basis, we were an underperforming market at the bottom quartile, which doesn't stay long for India per se. Hence, the setup is good to increase equity exposure, is what we feel. as you see on the screen, risk is more global than local, which anyway we can't live without with, right? There's nothing that we can do but to stay hopeful that uh, US will not get irrational or they'll not do something stupid, something like that. So keeping that faith in mind, I think uh, equity presents a decent risk reward equations both for the near as well as on the medium term. So we are much positive today than what we were 6 months back or 12 months back, in a nutshell. That would be my closing remark. And thanks everyone for joining us. Have a great weekend ahead, and we'll catch up soon for the next, you can say, update in the next month or so.
Yes, thank you, sir. Thank
Thank,
you, Aman, sir. Thank you,
thank you.
everyone.